Hi, owning a limited company gives you access to several really good tax saving strategies that can help you keep more of your hard-earned income legally. The reality is, if you don't owe it, you shouldn't pay it. In this video, I'm going to walk you through 7 proven ways to reduce your tax bill, and stay tuned because towards the end, I'm going to share a bonus tip that many business owners overlook. First up, a classic dance of salary and dividends. Think of it like Strictly Come tax efficiency. You don't want to pay yourself too much salary, or hello, employer's national insurance. Like a pro dancer's pirouette, it's a very fine balance. However, if you pay yourself too little, you'll miss out on your tax-free allowance. You might miss out on state pension contributions and end up with a mood that's heavier than Claudia Winkleman's fringe. So here's the sweet spot. If you take a salary just below the national insurance threshold, but be aware if there's only yourself on the payroll from the 6th of April 2025, that drops to £5,000, and then you top it up with dividends. There are other factors that do contribute to the amount you should pay yourself from the company, so don't jump the gun. For example, you want to really take a minimum $6,396 per year to make sure you're eligible for state pension contributions. And we recommend speaking with an advisor in most cases to avoid any nasty scares. Dividends come with tax-free allowances too, $500 for the year. I know, pitiful, but better than nothing. After that, they're taxed at lower rates than income tax, for example 8.75% at basic rate. But depending on your company's net profits, it sometimes can be better to take more of your income as purely salary, because that reduces your profit and therefore reduces your corporation tax. And this is where working it through with a good accountant is key. For example, if you're taking out a higher rate tax income, then you could end up with 19 to 20% corporation tax plus 33.75% dividend tax. Whereas if you take it all as salary, you'll pay 40% income tax, 8% national insurance, and the company though saves that 20% tax. So the overall rate is back down to 28% rather than 52%. Take a look at our video on director's salary for some really good inside tips on what to take and how, and it's a must view given the changes happening with the employer's national insurance. They're increasing as the allowance decreases. And that takes us nicely on to corporation tax, which is now 19% for profits below 50,000 and 25% for companies with profits of $250,000 or more. And if your profits fall between these thresholds, you're taxed on a sliding scale through what's called marginal relief. But what it really means is that every deduction counts. And the good news, you can claim a surprising amount of business expenses. The bad news, no, your Netflix subscription doesn't count as market research unless you're running a film review business. So consider business expenses like office supplies, software, travel, and even part of your home's running costs if you work from home. These can all reduce your taxable profits. Then there are things like training courses, professional memberships, even that fancy coffee machine for your office might qualify. And that beanbag you insist is for creative thinking, it's allowable. Just remember, if it's wholly and exclusively for business, the magic words, it's deductible. Check out our video on 30 allowable expenses you can claim to reduce your tax bill. And a pro tip, don't try claiming your dog's food as security expenses. HMRC is seeing it all and they're not laughing. And speaking of expenses, have you got your eye on a shiny new computer or a piece of office equipment? Well, you'll love this. Capital allowances let you claim the full cost of certain assets against your profits in the year that you buy them. There's something called the Annual Investment Allowance, or AIA for short, that means you can claim up to 1 million worth of qualifying purchases in a tax year. Basically, if it's got a plug or wheels, it might save you tax. Now, if you're finding this useful, hit that subscribe button. If you get to the bottom or the end and you don't think it was worth it, no problem. You can always unsubscribe. Next up is pension contributions. Do you want to save for retirement and slash your corporation tax bill? Well, enter pensions. Your future self will thank you and your current self gets a tax deduction. Win-win. You can contribute to a director's pension through your company and it's fully deductible as a business expense. And in addition, no national insurance is payable on them. Think of it like paying your future self a salary without the hassle of having to turn up to work. Now, let's cover VAT. If you're VAT registered, don't miss out on the VAT you can claim back. Even if you're not registered, applying for voluntary registration can be beneficial if you've got a lot of VATable expenses. To explain, you can claim VAT on purchases for your business like office supplies, equipment, materials, stock, even personal protective clothing. Some businesses actually spend quite a bit, particularly on things like materials. And it's often surprising how much VAT you're actually paying on a day-to-day basis without realising. And don't forget, if you recently registered for VAT, you might be able to reclaim VAT on past purchases going back up to 4 years in some cases. Just don't try to claim VAT back on that pool table in your games room unless your business is running snooker tournaments. Now, moving on, I have a question for you. Do you do anything remotely innovative in your business? If so, you might qualify for R&D Tax Credits. Now, you don't need to be inventing the next Tesla. Even improving the process could qualify. Not on the Tesla, I think that job's taken. But if your business develops new products, processes, or software, even just making small improvements, you may qualify, and that's even if you're not in a technical industry. You see, R&D tax credits allow you to claim back a percentage of your qualifying costs, and that includes staff wages, subcontractor costs, software, and materials. Think of it as HMRC paying you to be clever. Now, that's a partnership we can get behind. And lastly, have you ever borrowed money from your own company? It's crucial to make sure you plan it properly. Directors' loans can save you tax, but they also come with loads of extra charges if they're not managed right. There are some key rules to follow, and I'll run through some of those for you. Firstly, check your cash flow carefully to make sure it won't cause issues meeting all of your VAT and payroll requirements for payments. It should only ever be a short-term loan repaid within 9 months of your company's year end and the deadline for your corporation tax. If it's not repaid on time, a Section 455 tax charge of 33.75% applies, so plan ahead. Ideally, it should be under £10,000 because that avoids benefit in kind charges on your personal tax return and employers' national insurance payable by the company. Although if it is over £10,000, then paying interest on the loan at the HMRC approved rates will mean you don't have to pay benefit in kind. To give you an example, a client had a car accident where his car was written off and he used it for getting to various sites for work as well as personal. So it was really important that he had to be mobile again as soon as possible. The insurers were going to pay out, but it wouldn't be for about another 6 months. And he was 10k short of the money he needed for the car that he wanted. There was enough money in the company bank account to cover it, and plus after reconciling everything, it will cover the VAT bills each quarter, so his cash flow was all right, but it would be needed to pay the corporation tax. So the simplest solution was for him to borrow the money from the company, which was recorded as a director's loan. Because they paid out 4 months later, he was able to pay it straight back into the company with no additional tax or charges. So by managing it really well, it was a really useful short-term funding tool. So There you have it, my top 7 tips for paying less tax as a limited company. Remember, good tax planning is like a good accountant, pays for itself. If you found this helpful, don't forget to hit that like button and subscribe for more tips. And if you've got any questions, just pop them in the comments. Let's beat HMRC legally, of course. See you in the next video.